नमस्कार बेटा, अभी तक हमारे 5 लेक्चर्स कंप्लीट हो चुके थे। आज हम करेंगे लेक्चर नंबर 6 को स्टार्ट। जो हमारा फर्स्ट लेक्चर था बेटा, उसमें मैंने आपको चैप्टर नंबर 1 एंड चैप्टर नंबर 2 इकट्ठे स्टार्ट करवाया था। जो चैप्टर नंबर 1 था उसका नाम था इंट्रोडक्शन टू अकाउंटिंग और जो चैप्टर नंबर 2 था उसका नाम था बेसिक अकाउंटिंग टर्म्स। मैंने आपसे एक चीज बोली थी कि पहले 6 से 7 लेक्चर के अंदर आपको बुक की जरूरत नहीं पड़ेगी और पहले 6 से 7 लेक्चर के बाद आपके बुक के पहले 2 चैप्टर कंप्लीट हो जाएंगे। यस बोला था, यस। और अभी तक जो पहले 5 लेक्चर हैं बेटा, जो पहले दोनों चैप्टर हैं उसका 60 to 65% कवर हो चुका है। जो बाकी का रहता है वो आज के लेक्चर में कवर हो जाएगा। अब हम थोड़ी सी बातों को याद करते हैं कि पहले 5 लेक्चर्स के अंदर हमने किन किन चीजों को डिस्कस किया है। सबसे पहले हमने डिस्कस किया था नीड ऑफ अकाउंटिंग, कि अकाउंटिंग की जरूरत आखिर क्यों पड़ती है। फिर हमने समझा था मीनिंग ऑफ अकाउंटिंग, कि अकाउंटिंग आखिर है क्या। फिर हमने समझा था एक छोटा सा कॉन्सेप्ट, बिजनेस एंटिटी कॉन्सेप्ट, कि बिजनेस एक अलग चीज है, मालिक एक अलग चीज है, दोनों को एक दूसरे से सेपरेट मानते हैं और हम बिजनेस की अकाउंटिंग करते हैं। बिजनेस की अकाउंटिंग करते हैं, कभी भी प्रोप्राइटर की अकाउंटिंग नहीं करते आप। इसके बाद बेटा मैंने आपको अकाउंट्स की एबीसी समझाई थी, जिसको प्यार से बोलते हैं बेसिक अकाउंटिंग टर्म, और ये आपके सिलेबस का चैप्टर नंबर 2 है। बेसिक अकाउंटिंग टर्म्स के अंदर हमने जो चीजें डिस्कस की थी वो चीजें की थी, बिजनेस ट्रांजैक्शन क्या होती है, इवेंट क्या चीज होती है, ड्राइंग्स क्या होता है, कैपिटल क्या चीज है, एसेट्स, लाइबिलिटी, गुड्स, इन्वेंट्री, डेटर, क्रेडिटर, बिल रिसीवेबल, बिल्स पेबल, बैड डेट्स, डिस्काउंट, डेप्रिसिएशन, कैपिटल रिसिप्ट, रिवेन्यू रिसिप्ट, कैपिटल एक्सपेंडिचर क्या होता है, रिवेन्यू एक्सपेंडिचर क्या होता है, रिवेन्यू क्या होता है, इनकम, गेन, प्रॉफिट, इनके बीच में क्या डिफरेंस है, सब चीजें हमने प्यार से समझी थी। अब जब हम अपने कोई भी चैप्टर स्टार्ट करेंगे प्रैक्टिकल, तो आपको एक एक चीज का मतलब समझ में आएगा। तो हमने अकाउंट्स की एबीसी तो सीख ली भाई साहब, एक बेस तो बना लिया। इसके बाद लेक्चर नंबर 5 में मैंने आपसे अकाउंटिंग प्रोसेस की बात की थी, कि अकाउंटिंग का प्रोसेस क्या होता है। सबसे पहले क्या करते हैं, जो भी बिजनेस की ट्रांजैक्शन होती है उसको आइडेंटिफाई करते हैं, क्या वो बिजनेस से रिलेटेड है या नहीं है। फिर उसको मनी की टर्म में मेजरमेंट करते हैं, फिर उसकी क्या करते हैं, रिकॉर्डिंग, फिर क्लासिफिकेशन, फिर समराइजिंग, फिर जो रिजल्ट निकलता है उसको क्या करते हैं, एनालाइज करते हैं, फिर कम्युनिकेट करते हैं किसके साथ, यूजर के साथ। फिर हमने जो अकाउंटिंग प्रोसेस था इसको बेस लेकर एक डिफरेंस भी पता किया था, कि बुक कीपिंग क्या होती है एंड अकाउंटिंग क्या होती है। लास्ट लेक्चर में हमने इस चीज को समझा था। फिर हमने डेफिनेशन ऑफ अकाउंटिंग की बात की थी। इन सब चीजों को हम अभी तक डिस्कस कर चुके हैं बेटा। जो आज का लेक्चर नंबर 6 है, इसके लिए मैंने आपके लिए मैंने एक एनिमेटेड वीडियो तैयार कर रखी है। इस एनिमेटेड वीडियो के जरिए आप अभी तक जो भी हम पढ़ चुके हैं उसको रिवाइज करेंगे, और जो बाकी का हमारा रहता है, जो 30% रहता है, वो भी इस लेक्चर के अंदर कवर हो जाएगा। तो अब आप क्या करेंगे, ध्यान से प्रॉपर नोट्स बनाएंगे और इस एनिमेटेड वीडियो को देखेंगे। ठीक है जी, तो आप देखना स्टार्ट कीजिए इस एनिमेटेड वीडियो को जो मैंने आपके लिए बनाई है।
The following concepts are discussed in this topic.
Introduction to Accounting. Meaning of Accounting. Characteristics of Accounting. Functions and objectives of Accounting. Bookkeeping, Accounting and Accountancy. Branches of Accounting. Users of accounting information. Advantages and limitations of Accounting. Qualitative characteristics of accounting information. Important accounting terms.
Maruti Suzuki has been the undisputed leader of car manufacturing in India since it commenced production in 1983. The company has its manufacturing plants located at Gurgaon and Manesar in Haryana. The company annually exports more than 50,000 cars and has a large domestic market in India, selling over 730,000 cars annually. Maruti Suzuki enters into a large number of business transactions of monetary nature in the course of its business all through the year. Purchase of raw materials, payment of salaries to the employees, payment of rent for the warehouse, expenses on advertisement, payment of electricity bills, selling and marketing expenses, etc. Considering the volume of these monetary financial transactions, it is not possible for the management to remember all the transactions. However, at the year end, to determine whether the company is making profit or loss, Maruti Suzuki requires the results of its business transactions. This is where accounting comes into picture and helps Maruti Suzuki. Accounting helps the company in maintaining a systematic and complete record of all its business transactions. It is the process of collecting, recording, summarizing, and communicating the financial information to its users for correct decision-making.
Activities covered under accounting: identifying, measuring, recording, classifying, summarizing, analyzing, interpreting, communicating. The input for accounting are the economic events measured in financial terms. The process of accounting is done through recording, classifying, summarizing, analyzing, and interpreting. And the output is communicating information to users. Characteristics of accounting. Following are the main characteristics of accounting. Accounting is an art as well as science. It records only financial transactions. It records transactions in monetary terms. It performs various functions like identifying, recording, classifying, summarizing, interpreting, communicating. Accounting is an art as well as science. Art is the technique which helps us to attain desired objectives. Accounting is an art of recording, classifying, and summarizing financial transactions to ascertain the net profits and financial position of the business. Any organized knowledge which is based on certain specific principles is a science. Accounting is also a science, since it is also an organized knowledge based on certain basic principles. Records only financial transactions. Accounting records transactions of financial nature only. This is a serious limitation of accounting because it leaves out many business transactions which may be very important for business but does not have a financial character. For example, strike by employees, quarrel between the production manager and a sales manager, resignation of an efficient employee, etc. affect the earnings of the business but are not recorded because these events cannot be measured in terms of money. Let's check your knowledge. Resignation by a production manager is not recorded in the books of account. Why? Records monetary transactions. Each transaction is recorded in the accounts books in terms of money only to make them meaningful. For example, if a businessman purchases 300 tables, 500 chairs, 15 tons of raw material, 3 buildings, etc., it is not possible to add them together or know which one is more valuable unless they are expressed in terms of money. Performs various functions. Accounting is a process consisting of various steps which lead to certain conclusions.
Characteristics of accounting. Accounting is art as well as science. It records only financial transactions. It records transactions in monetary terms. It performs various functions such as identifying, recording, classifying, summarizing, interpreting, communicating.
Functions of accounting. Let's study the functions of accounting in detail. Identification of monetary transactions. Out of all business transactions, it identifies those transactions which involve money or can be measured in terms of money. Recording of monetary transactions. It records transactions in the form of journal or other subsidiary books like cash book, sales book, purchase book, etc. Classifying the recorded transactions. Groups transactions of the journal to various ledger accounts. For example, all transactions with Mr. Y, customer of our business, will be grouped at one place. Summarizing the classified transactions. Presents the data in useful manner in the form of preparing trial balance, trading and profit and loss account and balance sheet. Interpretation of the results. Analyzes and interprets the data so that interested parties such as proprietors, managers, creditors, etc. can have information of the financial position of business. Communicating the results. It communicates the financial data to its users for analysis and decision making.
Functions of accounting. Identifying the monetary transactions. Recording the monetary transactions. Classifying the recorded transactions. Summarizing the classified transactions. Interpretation of the results. Communicating the results.
Accounting cycle or process of accounting. Accounting cycle starts with the recording of transactions in the journal or subsidiary books, and after passing through the ledger and trial balance, helps in the preparation of final accounts such as trading and profit and loss account and balance sheet. This cycle is generally completed in an accounting year and again repeated from next year. Objectives of accounting. Accounting helps in maintenance of records of business transactions. Main objective of accounting is to keep complete record of business transactions according to specified rules. It helps in calculation of profit and loss. Owners of a business are interested in knowing the performance of the business periodically. It states the reason of profit or loss. It tells us how the profit has risen in the business and vice versa. It is helpful in knowing the financial position of the business. Financial position is known by preparing balance sheet. It shows the list of assets, liabilities, and capital on a particular date. It is helpful in preventing and detecting errors and frauds. It helps to prevent or stop the frauds done by employees and others. It helps management in controlling. Accounting gives important information to management for timely decision making. Let's check your knowledge. Recording the transactions and events correctly and preparing the financial statements are the only objectives of accounts. Do you agree with the statement?
Objectives of accounting. Maintenance of the records of business transactions. Calculation of profit and loss. Stating the reason of profit or loss. To know the financial position of the business. To prevent and detect errors and frauds. Control of management.
Bookkeeping, accounting, and accountancy. Bookkeeping. It is a part of accounting and mainly concerned with recording of financial data in the books of account. It includes the following activities: identifying financial transactions, measuring financial transactions in terms of money, recording these transactions in the books of account, posting them into ledger. Accounting. It is a wider concept than bookkeeping and starts where bookkeeping ends. It consists of the following activities: summarizing the classified transactions in the form of profit and loss account and balance sheet, analyzing and interpreting the summarized results, communicating the information to the interested parties. Accountancy. It refers to a systematic knowledge of accounting concerned with the principles and techniques which are applied in accounting. It explains how to prepare the books of accounts, how to summarize the accounting information, how to communicate it to the various users. Difference between bookkeeping and accounting. On the basis of scope, on the basis of stage. On the basis of objective, on the basis of nature of job. On the basis who performs the work, on the basis of special skills. Let's check your knowledge. Bookkeeping is not a part of accounting. Is this statement correct?
Bookkeeping. It is a part of accounting and is mainly concerned with the recording of the financial data in the books of accounts. Accounting. It is a wider concept than bookkeeping, and it starts where bookkeeping ends. Accountancy. It refers to a systematic knowledge of accounting concerned with the principles and techniques which are applied in accounting.
Branches of accounting. Following are the main branches of accounting: financial accounting, cost accounting, management accounting, tax accounting, social responsibility accounting. Financial accounting. It records the financial transactions of business in a systematic manner. It determines the profit or loss during a period and presents the financial position of the business. It provides financial information to the management and outside users. Cost accounting. It ascertains the total and per unit cost of goods manufactured or services rendered by the firm. It helps the management in cost control and price fixation. Management accounting. It is a recently developed branch of accounting. It presents the information related to funds, costs, and profits using techniques like ratio analysis, budgets, etc. to help the management in decision making. Tax accounting. It is used for tax purposes. Income tax are computed with the help of this accounting. Social responsibility accounting. Every business has some responsibilities towards society, which provides basic facilities to business. Process of identifying, measuring, and communicating the contribution of a business towards society, which include employment to underprivileged, environmental contribution, etc.
Branches of accounting. Financial accounting, cost accounting, management accounting, tax accounting, social responsibility accounting.
Users of accounting information. Basic function of financial accounting is to provide accounting information to various users and enable them in taking decisions. Users of accounting information may be categorized into internal users and external users. Internal users are of two types: owners and management. External users may be categorized into lenders, investors, creditors, employees, government, researchers, society. Internal users. Internal users are the people who are directly involved in managing and operating the business enterprise. The term internal users includes owners. Owners invest money in the form of capital in the business and thus are always exposed to risk. They are interested in knowing the profitability and financial soundness of the business to ensure safety of their capital. Management. In large-sized enterprises, businesses are managed by professional managers who have direct control over the business. They make extensive use of accounting information for important decisions like determination of selling price, cost controls, investment into new projects, etc. External users. They depend on the published sources of accounts like profit and loss account and balance sheet. The term external users includes lenders. Banks and financial institutions lend money to the business, and before providing loan, they want to judge the repaying capacity of the business. Investors. They want to know the earning capacity of the enterprise and safety of their investment. Creditors. They supply goods and services on credit and thus want to know the capacity of the business to pay their claims on time. Employees. They need information about the profits of the business to claim increase in salary, bonus and other benefits. Government. To collect various taxes like income tax, etc., government requires necessary information. Researchers. To study the financial operations of a particular industry or firm, they require necessary information. Society. Enterprises have responsibility towards the society, such as providing employment, environment protection, product safety, etc. Through social responsibility accounting, expenses on these contributors and the benefit to society can be measured. Advantages of accounting. Accounting gives financial information about business, profit earned or loss suffered, position of assets and liabilities on a particular date. Accounting replaces memory through tracing the required transaction. Accounting helps in the valuation of the business if it is to be sold. Accounting facilitates comparative study, comparing the results of one year with another year, comparing performance of business with other firms in similar business, identifying factors leading to differences in results. It helps in management for short and long-term decision-making to exercise effective control. Accounting is helpful in calculation of tax liability. Assessment of income tax liability. Tax authorities accept only proper records of accounts. Accounting prevents and detects errors in the business which may be committed by the employees. Accounting work as evidence in the court. Properly maintained accounts supported by authenticated documents are accepted as evidence in the court. Accounting is helpful in raising loans. Banks and financial institutions provide loans on the basis of financial records.
Advantages of accounting. Gives financial information about the business. Replaces memory. Helps in the evaluation of the business. Facilitates comparative study. Assists management. Helps in the calculation of tax liability. Prevents and detects errors in the business. Evidence in legal matters. Helpful in raising loans.
Limitations of accounting. Inaccurate results. Some calculations are based on estimation. Accountants have different ideas about such estimates. Estimates differ in cases such as useful life of the asset, possible bad debts, market price of the goods, etc. Assets are not shown at realizable value. Assets in the balance sheet are shown at the cost of purchase and not at the realizable value, since assets are meant for use and not for resale. Exclusion of qualitative information. Accounting records only those transactions which can be converted in terms of money. Factors like quality of management, workforce, industrial relations, etc. are ignored. It works as a past record only because accounting statements are prepared at historical cost. The effect of price level changes is not considered. Accounting is affected by window dressing because there is a possibility of manipulation of accounts. Let's check your knowledge. The accountant of Alloy Limited does not want to give the previous year's figures, a practice followed by the firm from a very long time. Is the accountant's decision correct? Let's check your knowledge. One of the main limitations of accounting is that it is based on historical cost. What could be the probable effect of this on financial statements?
Limitations of accounting. Inaccurate results. Assets are not shown at their realizable value. Exclusion of qualitative information. Past records only. Affected by window dressing.
Qualitative characteristics of accounting information. Following are the main qualitative characteristics: reliability, understandability, relevance, comparability. Reliability. Accounting information must be reliable. Reliability of information means it is verifiable. Understandability. It means users must be able to understand the presented information. Relevance. Information must be relevant for different decision makers guided by the principle of materiality. Comparability. Users should be able to compare the accounting information from one firm to another firm and from one period to another period. Mercantile system of accounting. In this system of accounting, incomes are considered when actually earned, whether received or not, and expenses are charged to the period when incurred, whether paid or not. This system shows true profit or loss and true financial position. This system is also known as accrual system of accounting. Important accounting terms. There are certain basic accounting terms which are part of the standard accounting terminology and are used daily in the business world. Therefore, it is necessary to understand these terms. Business transaction. An economic activity of the business that changes its financial position. Features of business transaction. It involves an economic activity. It changes the financial position of the firm. It is expressed in terms of money. Transactions may be of two types: external transactions, internal transactions. Account. Record of all business transactions related to an individual, asset, liability, expense or income at one place. According to Carter, an account is a ledger record in a summarized form of all the transactions that have taken place with the particular person or things specified. Capital. Amount invested by the proprietor in a business enterprise, with the help of which goods and assets are purchased in the business. Drawings. Cash or value of goods withdrawn by the owner for personal use or any private payments made out of business funds. These reduce capital brought in by the owner. Expenses. Cost incurred in producing and selling the goods and services. According to Finley and Miller, expense is the cost of use of things or services for the purpose of generating revenue. Expenses include following items: cost of goods sold, amount paid for salary, commission, rent, advertisement, etc. Decline in the value of the assets caused by the use for business purpose or depreciation. Income refers to the profit earned during a period, that is, the difference between revenue and expense. Income is equal to revenue minus expense. Income is different from revenue. Let us take an example to understand the term income. Profit. Excess of total revenues over total expenses of a business enterprise for an accounting period. It increases the investment of the owners. Profit is further categorized into gross profit and net profit. Gross profit. It is the difference between sales revenue over the direct costs. Net profit. It is the profit made after allowing for all expenses. If expenses are more than the revenue, it is the net loss. Gain. Profit arising from transactions which are incidental to business, such as sale of investments or fixed assets at more than their book values. Let's understand with the help of this example. Loss. Excess of total expenses over total revenues of a business enterprise for an accounting period from normal business activities. It decreases the owner's investment. Note: losses differ from expenses. Expenses are incurred to generate revenues, whereas losses bring no benefit. Purchase. The term purchase is used only for the purchases of goods in which the business deals. It includes both cash and credit purchases of goods. Note: goods are things which are purchased for resale or for producing the finished products which are also to be sold. Purchase return. When purchased goods are returned to the suppliers, these are known as purchases return. It is also known as returns outwards. Sales. The term sales is used only for the sale of those goods in which the business deals. It also includes revenues from services provided to customers. It includes both cash and credit sales of goods. Note: the term sales is never used for the sale of assets. For example, if a cloth dealer sells cloth, it will be termed as sales. But if the same dealer sells old machinery or furniture, it will not be termed as sales. Sales return. When a customer returns the sold goods, it is known as sales return or return inwards.
Business transactions. It is an economic activity of the business that changes its financial position. Accounts. It is the record of all the business transactions related to an individual, asset, liability, expense or income at one place. Capital. It is the amount invested by the proprietor in a business enterprise with the help of which goods and assets are purchased in the business. Drawings. It refers to cash or the value of goods withdrawn by the owner for personal use or any private payments made out of business funds. It is the excess of total revenues over total expenses of a business enterprise for an accounting period. Gain. It refers to the profit arising from the transactions that are incidental for business, such as the sale of the investments or fixed assets at more than their book values. Loss. It refers to the excess of total expenses over total revenues of a business enterprise for an accounting period for normal business activities. Purchase. It is used only for the purpose of those goods in which the business is dealing. It includes both cash and credit purchase of goods. Purchase return. When the purchased goods are returned to the suppliers, they are known as purchase returns. This process is also known as returns outwards.
Trade receivables. As per Schedule 3 of the Companies Act 2013, it is the amount receivable from sale of goods or services rendered in the ordinary course of business. Receivable within a period of 1 year. For example, sundry debtors and bills receivable. Debtors. These are the persons or firms to whom goods have been sold or services rendered on credit and the payment has not been received from them. Bill receivable. It means a bill of exchange accepted by a debtor, the amount of which will be received on the specified date. Trade payables. As per Schedule 3 of the Companies Act 2013, it is the amount payable for purchase of goods or services bought on credit in the ordinary course of business. Trade payables include creditors and bills payable.
These are the persons or firms from whom goods have been purchased or services procured on credit and the payment has not been made to them.
Bill payable. It means a bill of exchange accepted, the amount of which will be payable on a specified date.
Goods. All those things which are purchased for resale or used for producing the finished products which are also meant to be sold. Note: for a furniture dealer, purchase of chairs and tables is termed as goods, while for others it is furniture and termed as an asset. It is allowed by the seller to the buyer. Trade discount is given on printed price to promote sales. Cash discount is given for the prompt payment by the buyers. Liabilities. It refers to an amount which the firm owes to outsiders, except the amount owed to proprietors. According to Finney and Miller, liabilities are debts, they are amounts owed to creditors. Liability can be expressed as liabilities is equal to assets minus capital. Let's understand the term liabilities with the help of following examples. When a firm purchases goods from X on credit, the amount owing to X is a liability. Similarly, when a bank account is overdrawn, the amount owing to the bank, that is, bank overdraft, is a liability. Other examples are creditors, unpaid expenses, bills payable, etc. Internal liabilities. Amounts which a business entity has to pay to the owners or proprietor are known as internal liabilities. For example, capital of owners and accumulated profits. As business transactions are recorded considering the business to be a separate entity from its owners, the capital invested by the owners is an internal liability. External liabilities. Amounts which a business entity has to pay to the outsiders are known as external liabilities. For example, creditors, bills payable, loans, etc.
External liabilities under Schedule 3 of the Companies Act 2013 are classified into non-current liabilities and current liabilities. Non-current liabilities refer to liabilities which are payable after a long period, normally more than 1 year. For example, long-term loans, debentures, etc.
Current liabilities refers to those liabilities which are payable in the near future, normally within a year. For example, creditors, outstanding expenses, bank overdraft, short-term loans, bills payable, etc.
Debtors. These are the persons or firms to whom goods have been sold or services rendered on credit and the payment has not been received from them. Creditors. These are the persons or firms from whom goods have been purchased or services procured on credit and the payment has not been made to them. Goods. It refers to all those terms that are purchased for resale or are used for producing the finished products meant to be sold. Liabilities. It refers to the amount that the firm owes to the outsiders, except the amount owed to the proprietors.
Assets. It refers to anything which is in the possession or is the property of the business, which will enable a business enterprise to get cash or a benefit in future. For example, land and building, plant and machinery, stock, furniture and fixtures, motor vehicles. According to Finney and Miller, assets are future economic benefits, the rights of which are owned or controlled by an organization or individual. Characteristics of assets. Following are the main characteristics. These resources are valuable to the business. These resources are owned by the business. These resources are acquired in money measurable cost. Fixed assets. Assets which are purchased for continuous use in the business for the purpose of producing goods or providing services and are not held for resale. For example, furniture, land, building, machinery, etc.
Non-current assets. As per Schedule 3 of the Companies Act 2013, these are assets which are not current assets. They are not held for the purpose of selling but are held to improve the earning capacity of the business.
Tangible assets. Assets which have physical existence, that is, they can be seen and touched, are known as tangible assets. For example, cash, building, computer, furniture, land, stock, machinery, etc. Intangible assets. Assets which do not have physical existence, that is, they cannot be seen and touched, are known as intangible assets. For example, patents, goodwill, trademarks, etc. Assets. Assets which are meant for sale or which are to be converted into finished goods or into cash within 1 year are known as current assets. For example, debtors, stock, bills receivable, cash in hand, cash at bank, etc.
Fictitious assets. Assets which are neither tangible assets nor intangible assets. They are losses not written off in the year in which they are incurred but in more than one accounting period. For example, deferred revenue expenditure, discount on issue of shares, etc.
Assets. It refers to anything that is in the possession or is the property of the business, which will enable a business enterprise to get cash or benefit in future. Current assets. Assets that are meant for sale or which are to be converted into finished goods or into cash within 1 year. Tangible assets. Assets that have physical existence, that is, they can be seen and touched. Examples: cash, building, computer, furniture, land, stock, machinery, etc. Intangible assets. Assets that do not have physical existence, that is, they cannot be seen and touched. Examples: patents, goodwill, trademarks, etc.
Receipts. Receipt is the amount received or receivable for selling assets, goods or services. Important to make a proper distinction between revenue receipts and capital receipts, because revenue receipts are shown on the credit side of trading and profit and loss account, whereas capital receipts are shown in the balance sheet either as increase in liabilities or as reduction in the value of the assets. Revenue receipts. Revenue receipts refer to amount received from sale of those goods and services in which business deals. Capital receipts. Capital receipts refer to an amount received from other than the normal business transactions. An expenditure refers to any payment of cash or transfer of property or incurring a liability for the purpose of acquiring assets, goods or services. Expenditure may be classified into 3 categories: capital expenditure, revenue expenditure, deferred revenue expenditure. Capital expenditure. It is an expenditure incurred for the acquisition or erection of fixed asset or improvement of an existing fixed asset. Capital expenditure is of non-recurring nature, that is, they are incurred whenever need for incurring them is felt. Capital expenditure is incurred to increase the earning capacity of the business. Capital expenditure yields benefit over a long period. Capital expenditure is shown on the asset side of the balance sheet. Following are the examples of capital expenditure. Amount spent on the purchase or erection of building, plant, furniture, acquisition of trademarks, and acquisition of goodwill. Expenditure. It is an expenditure incurred to purchase goods and services for consumption in the normal course of business operations. It is of recurring nature because business is continuously carried on. It is incurred to maintain the efficiency of business assets and the earning capacity of business. It yields benefit for a maximum period of 1 year. It is shown on the debit side of trading and profit and loss account. Following are the examples of revenue expenditure: manufacturing expenses, salaries and wages, commission, rent or electricity charges, interest on capital and loan, etc. Deferred revenue expenditure. It is revenue in nature, but the benefit of it is likely to be derived over a number of years. Benefit of such expenditure generally lasts between 3 to 7 years. Whole amount of such type of expenditure is not debited to the profit and loss account of the current year, but spread over the years for which the benefit is likely to last. Let's understand deferred revenue expenditure with the help of an example. For example, Coca-Cola has spent a huge amount of 50 lakh rupees on advertising to introduce its new product in the market. It is estimated that its benefit will last for 5 years. In this case, 10 lakh rupees will be charged to the profit and loss account of each year for 5 consecutive years. Here, 50 lakh rupees is deferred revenue expenditure. Are the examples of deferred revenue expenditure: heavy advertisement expenses, research expenses, preliminary expenses, discount on issue of shares and debentures, underwriting commission. Stock. Tangible property held by an enterprise for the purpose of using it in the production of goods meant for sale or for sale in the ordinary course of business. It is also known as inventory. Stock may be of 2 types: opening stock, closing stock. Opening stock. Value of goods lying unsold at the beginning of the accounting period. Closing stock. Value of goods lying unsold at the end of the accounting period. In case of a manufacturing company, opening and closing stocks may be of 3 types: stock of raw material, stock of work in progress, stock of finished goods. Stock of raw material includes stock of raw materials purchased for using them in the manufactured products but still lying unused. For example, value of cotton in case of cloth mills. Stock of work in progress. Goods in semi-finished form which need further proceeding for converting into finished products. For valuation, value of raw materials used, labor cost, power, etc. on proportionate basis are included. For example, in case of cloth mills, value of threads and the unfinished cloth will be the stock of work in progress. stock of finished goods, stock of completed goods which are ready for sale but are lying unsold at the end of the accounting period. For example, value of finished goods in case of cloth mills.
Revenue receipt. It refers to the amount received from the sale of those goods and services in which the business deals. Capital receipt. It refers to the amount received from transactions other than the normal business transactions. It includes receipts from sale of assets, shares, debentures, etc. Expenditure. It refers to any payment of cash or transfer of property or incurring a liability for the purpose of acquiring assets, goods or services. Stock. It refers to the tangible property held by an enterprise for the purpose of using it in the production of goods meant for the sale or for sale in the ordinary course of business. It is also known as inventory.